So good afternoon, everyone. This is Abdullah, and I have with me Wa'il. We have with us a special guest, Mr. William Green, with the Finance Memo. It's May the 27th, and we're very excited to have a special guest with us. So welcome, Mr. Green.
Thank you. I'm delighted to be here, and it's a particular honor because I've spent time in Saudi Arabia maybe a decade ago, and I have very fond memories of the country. So it's lovely to be able to speak to your audience. So thank you for the opportunity.
Thank you for your kindness. For our first question, we would love to know more about yourself, some background, some of your beginnings, and what led you to writing this book.
Yeah, it's a long story. I grew up in England. My father was a judge and a barrister, a lawyer in England, and I went away to this very fancy English school, Eton, which is where people like Prince William and Prince Harry and David Cameron and Boris Johnson went, and I was a little bit of a rebel while I was there. I was supposed to be becoming a very posh English gentleman, and instead I would sneak out of the school and I would go gamble on horses. There was a turf accountant, what they call in England, where you could bet on horses, and this was totally not allowed. It was, my parents were appalled. It was not allowed to sneak out of the school. This is a school where literally we wore a tailcoat and a waistcoat and a starched white tie. It was very formal. And so I was supposed to be becoming a good honorable gentleman. But the reason I was so fascinated by the horses, it was really the idea that by thinking well, you could make money. But I soon discovered that gambling was just stupid, that it was all stacked so that it would make money for the casino, not for me. And after maybe 2 months, I stopped and I've never gambled again. But then about a decade later, when I was in my early to mid 20s, I discovered the stock market, and I thought, wow, this is the real game. This is where the action really is, because this is somewhere where if you think well, you're able to achieve extraordinary results without without going to do anything too painful, right? It's not like I was going to have to, farm or work in a store or something like that. And I was kind of a bit lazy, right? And I was a little bit subversive, and I was an intellectual, and I thought, the idea that you could use your mind to make money was a very beautiful thing. And so I started to study the stock market fairly obsessively. And I read a lot about stocks and mutual funds. But I had this very unusual advantage, which is that because I was a young journalist, I was actually able to go and interview great money managers for magazines like Forbes and Fortune magazine, and later for Barron's and for Time magazine and Worth. And so I would do things like I would go to the Bahamas and I would spend a whole day with Sir John Templeton, who was probably the greatest international stock picker of the 20th century. And I would be learning from these people how to invest. And so I would learn from him about all of the traits of the greatest investors. And then I would go off and I would interview someone like Jack Bogle, who was the pioneer of index funds. And he founded Vanguard, which now manages something like $6.2 trillion. And so it was almost like this masterclass that I was taking, speaking to the greatest investors of all time. And so over the years, my view of what investing was about became a little more mature. And instead of that kind of childish hope of just thinking, oh, let me just gamble and make money without getting my hands dirty, I started to realize that the greatest investors were extraordinary thinkers, that they're not just gifted at making money. They actually are very gifted at thinking about what works in the world, how to make sense of all of the uncertainty and complexity of the world that we live in. And they're dealing with these very philosophical problems, like the fact that the future really is unknowable and that everything changes the whole time. And so how do you make decisions about the future? And that's a very philosophical question. And so in this book, Richer, Wiser, Happier, that I've just published recently, I'm talking to the smartest, wisest investors that I've interviewed over the last 25 years about these very practical but also quite philosophical questions of how do I become a better decision maker? How do I very subtly stack the odds in my favor, not just in investing, but in every area of life, so that I can become not only richer, but actually also wiser and even happier. And so in a sense, this book is the culmination and the fruit of this 25-year journey from being this smart aleck kid who just wanted to get rich without working, to actually thinking about how can I deal with the uncertainty of life? How can I make my way through this murky, complex world in a wise way? And what does it mean to live a good life? What does it mean to be a moral person? What does it mean to look back at the end of your life and say, I lived my life well, and I behaved in an honorable manner? And so these are some of the questions that I've been focusing on in this book.
Well, I would recommend the book to anyone listening. I love how you've took the essence of each investor and did not take a long time to provide that to the readers, which is a great thing. I wanted to ask you more about the people you've interviewed. Some of them are extremely media shy, like Nick and Zach. How did you go and interview these guys? How did you make them agree to the interview?
I think, as in many areas of life, it's all about trust. And you're trying to gain people's trust. And the only way really to gain people's trust is to try to behave in a decent and trustworthy way. Charlie Munger, Warren Buffett's partner, who I write about at length in the book and who I interviewed for the book, often says the best way to get a good partner is to be a good partner. And the best way to have a good marriage is to be a good spouse. And I think this goes for everything, that the way you behave in everything that you do either builds trust or destroys trust. And so in the case of Nick Sleep, for example, who's a remarkable investor who you talk about, who's never really spoken to the press at all, I met him initially through my friend Guy Spear, who's a very well-known hedge fund manager and author who you've had recently on your show. And he's a wonderful person. And because he's such a good and decent human being, he has a lot of trust. He's very interested in this idea of compounding goodwill. So instead of just compounding money, what you're trying to do is compound goodwill by behaving in a very decent way. And one of the benefits of this is he's surrounded by people who like him and trust him. And so he initially was talking to Nick Sleep about a project that Nick Sleep was working on that was a writing project. And he said to Nick, you should really talk to my friend William, because I had helped Guy Spear write his memoir, The Education of a Value Investor, which I think is a wonderful book because it's so honest and open and candid about his mistakes and what he's learned over the years. So I would encourage everyone to read that. And so I think Nick Sleep was happy to meet me for that reason, because he trusted Guy. And then I went and spoke with Nick in his office in London, which is this beautiful sunny office on the King's Road. It doesn't look anything like a normal money manager's office. It's above I think it was above a Chinese herb store. And he and his partner, Zach, have beekeeper suits there. I mean, it's a very eccentric place, sunny and lovely and bright and unconventional. And so I think Nick and I built up this trust, partly because I went not to try to get an interview, but actually to see if I could help him and give advice on this project of his. And so gradually we built trust, we became friendly, and then I started to interview him. And I think I was so deeply engaged in his story, and it became clear that I wasn't just trying to get a quick hit where I would kind of exploit him and use his name and to get publicity for me. I was actually deeply engaged in the ideas that he was trying to share and trying to teach. And so because I was so engaged, I think he really opened up. And then at a certain point, he spoke to Zach, who is his partner, who's a wonderful guy. And Zach is even shyer than Nick, would never spoke to the press. And so I think because I'd won the trust of Nick, then Zach spoke to me. And then when it came to fact checking, I really was very open with them about what I'd written. And so it was really a dialogue. And so they could add nuance and new information. And so I think this is a very long-winded answer, but I think actually it gets at something quite important in life, which is when you try to behave in a way that engenders trust, it's long-term smart, as Warren Buffett would say. It attracts a certain type of person into your life and they open up to you. And then once you've spoken to that person, then another person is likely to speak to you because they've seen how you've behaved in that situation. And so I do think there's a powerful lesson in here. And it's something that I've learned from seeing people like Guy Spear and Nick Sleep behave really decently, that you start to think, oh, that's a good model. Let me behave more like that. And there's a wonderful line from Warren Buffett where he talks about, this is in a forward to another book, a book by Janet Lowe that's a biography of Charlie Munger, where Buffett is talking about his partnership with Charlie Munger. And he says, in 41 years, I've never seen Charlie take advantage of anybody. And he says, I've seen him take the worse end of a deal willingly multiple times, give me the better end of a deal, other people a better end of a deal multiple times. And when there's credit to share, he takes less of the credit than he deserves. And when there's blame, he takes more of the blame than he deserves. And if you think about that, there's really deep wisdom in that. And Charlie Munger and Warren Buffett have been partners for more than 40 years, and they've built the most successful investment partnership of all time. And they're very different because Charlie is a Republican, for example, and Warren is a Democrat. So they're politically different. And yet they've built this deep friendship built on trust and honor and transparency with their shareholders. You know, Warren Buffett's salary for running Berkshire Hathaway, which is one of the biggest companies in the world, I think is $100,000 a year. And so they're acting in this very honorable way that I think draws extraordinary people into their environment. And so I would say this is a real unappreciated advantage in life that, and I'm not trying to be self-righteous or pious or you know, proselytizing. I just think it's really wise to behave in a decent and moral and ethical way because you draw better people into your environment. And that's such a powerful secret to success in life.
To be frank, everything you mentioned today resemblance very well with young investors. This is something that they should do along with investing and along in their lives. So that was a great question, a great answer.
Thank you.
In terms of our next question, we'd love to dig deeper a bit and know more about what inspired you to write the book. What was the main driver behind writing this book?
I've had this extraordinary opportunity over really 25 years to interview many of the greatest investors, people, as I was mentioning before, like Jack Bogle, Sir John Templeton, Charlie Munger, Howard Marks, Joel Greenblatt, really a who's who of the greatest investors. And I thought, what an amazing thing if I could distill the most important ideas from these people, not only about how to get rich, but actually about how to think and how to live more wisely. And there was partly that was selfish because I'm confused in life, right? Life is murky and foggy, and I've had failures and setbacks and challenges and fears and anxiety, and I'm trying to figure out how do I navigate my way through the world. But partly it's also selfless because there's a really great pleasure in sharing these ideas with other people. And if I can distill these ideas for myself and for my children and for relatives and for strangers and say, these ideas are really helpful and they're really robust, and this is what I figured out. That's a beautiful thing. And I think that selfless aspect of it actually, I think is a great motivator, because if it were just about me, if it were just, if it were me saying, let me build my brand and become rich and famous and stuff, I think people would smell that. And I think people sense your motivation. And so if you're doing things thinking, let me share some wisdom that can help me and that can help other people, I think it puts you in a better place. And so what I hope people get from the book is some really practical wisdom from people like Charlie Munger and Howard Marks and many others that I hope is really powerful. And one of the things that was a great joy for me was, because I've interviewed such remarkable people over so many years, I could I could actually share wisdom that they'd received from the people who had influenced them most. And so, for example, when I was writing about Jack Bogle talked to me about his mentor. And so Bogle died several years ago, and his mentor died many years ago. But I'm able to share the wisdom that he learned from this man that very few of us have heard of, who was one of the pioneers of the mutual fund business in the US, a man called Walter Morgan. And when I asked Jack Bogle about Walter Morgan, it was actually originally, it was on the phone that I was speaking to Jack Bogle, and the phone went dead. And I said, this is about 20 years ago, and I said, Mr. Bogle, have I lost you? And I thought the line had just gone dead. And he said, no, I'm here. He said, it's putting tears in my eyes. And I said, why? Why are you so emotional about this? And he said, because I realized how much I loved him and how much he helped me. And one of the things that Walter Morgan said to Jack Bogle that I found very memorable and that I wanted to share with my readers is he said that for Walter Morgan, the shareholder is king. And so he really took seriously his sense of duty, this kind of covenant between him and the shareholder, the sense that he was a custodian of their capital, of their life savings, of their retirement money, of their children's college money. And so he said that once a shareholder in Walter Morgan's funds wrote to him and said, Mr. Morgan, I don't have a suit. And he said, my God, Mr. Morgan sent that man a suit. And if you think about that behavior, that act of generosity that Walter Morgan, this guy none of us have really heard of and who died a long time ago, that's something worth preserving. And I would say that mentality got carried through into Jack Bogle, and it infused the spirit of Vanguard and indexing, because they were looking out for the shareholder. And so I think good behavior, as Nick Sleep would say, good behavior has a long shelf life. And so part of my purpose in writing the book was to take things like that were easily forgotten. It would be very easy for none of us ever to hear about Walter Morgan, and for none of us to know about this small act of kindness that shaped Jack Bogle and that informed Jack Bogle's desire to help shareholders. And so if I can help investors, also money managers, to say, well, how do I want to behave? Do I want to be gouging my shareholders and ripping them off and overcharging them and behaving in an unethical way and just lining my own pockets as much as possible, making, so that I can buy a bigger house and a bigger yacht and a bigger plane? Or do I want to, or will they look at someone like Jack Bogle or Nick Sleep or Tom Gaynor, some of these investors I write about, and say, no, actually, I'm a custodian of their life savings. And the way that I treat my shareholders, it's a sacred trust. And so there's something, I'm not trying to proselytize here, but I do think there's something deeply moral and spiritual about the investment business, if you see it through the right lens. But it's very easy for us to lose our way and to say, to look at the wrong example and say, no, it's all about just becoming richer, and to forget that, no, there's this other aspect of it's also about becoming wiser, happier, more honorable, more decent, and being able to look at yourself at the end of your life and say, yeah, even though I'm a deeply flawed human being, I tried to work on myself and to become a better person and to behave decently.
Most people have this Gordon Gekko type of mindset towards people in finance. Everyone is greedy, everyone wants to make a quick buck out of people. But most of the famous investors are great people who are looking towards the benefit of their shareholders, especially someone like Bogle, who is an icon in investing and provided us with zero-fee funds, which we see today. So you've had the pleasure of interviewing Charlie Munger. Not many people have had that pleasure. So could you tell us more about that experience? Munger is very honest, so he has a lot of radical opinions. So what did he tell you in that interview? What did you learn from that?
Yeah, I was scared to go interview Munger because he has this reputation as being fearsomely direct, brutally honest. And Warren Buffett says that Charlie has the best 30-second mind in the world. He says that he can see the essence of everything before you've even finished the sentence. He knows the answer. And Monish Pabrai, who I write about at length in the book, who's very close to Guy Spear and is a great hedge fund manager, an extraordinary person, knows Charlie very well and said to me, he's a quantum leap above Warren Buffett in terms of intelligence. And when you think that Warren is a genius, that gives you a sense of the fearsome intellect of Munger. And so I was pretty nervous because I thought, well, here's this guy who's going to see through me. He's going to see what an idiot I am. And so I better prepare a lot for this interview. So I spent weeks reading his old speeches and essays. And gradually what I came to realize that really fascinated me is that here you have one of the smartest people alive. And yet what he's really doing is focusing on systematically reducing what he calls standard stupidities. And this struck me as a great paradox. Most of us, as he puts it, are trying to become smarter. And he says there's a tremendous advantage just to trying not to be stupid. And if you can consistently avoid stupidity and live a long time, he says, you have such an enormous advantage over everyone else. And so this is the subject of the chapter that I write about Charlie Munger primarily. It's called Don't Be a Fool. And it's about how to systematically reduce standard stupidities. And one of the things that Munger does that I think is very helpful for all of us is he collects examples of stupid behavior, both by other people and himself, mistakes that he's made, and he reverse engineers them. He says, okay, what were the causes of this disaster? And let me figure out why everything went wrong. And then let me not do that. Let me consistently not do that. So if you think about this for investors, it's a really profound idea and very practical. So if you start to think, if you were to list all of the ways in which regular investors and even some professional investors mess up, the stupid things they do, right? And then you just decide, let me not do that. It's very helpful. And so if we just think off the top of our heads of some of the stupid things that investors do, and I've done many of them myself, so I'm not trying to be too judgmental here. We do things like we rent stocks for the short term instead of owning them for the long term. We try to time the market when actually it's pretty clear that it's futile to try to time the market. That if you get lucky and you get out at the right time or you get in at the right time, you're not going to then get the other side of the trade, right? So say you guess right and you cash out right before the market crashes, then you'll miss the surge subsequently. And so that's just a losing bet if you build into your life this mindset of jumping in and out of the market and trying to time things. It's probably a mistake to let fees and high expenses erode your returns. That's a standard stupidity, right? If Jack Bogle showed that if, for example, you invest $1 million and it compounds at, I think, 10% a year over 30 years, if I remember rightly, it becomes $17.5 million. If you buy an actively managed fund that charges 1.5% a year, and that money compounds at 10% a year over 30 years, your return would be 11.5 million. So that difference, that 1.5 percentage points in expenses each year, actually erodes your return by $6 million over 30 years. So that's a standard stupidity to let your expenses and your fees get the better of you and erode your return. So these are just a few examples. Another one that he mentioned to me is, he said people again and again will buy a cyclical company at the top of the cycle where Wall Street has convinced them that this magic is going to continue forever. And he says they fail to realize that things will fall back, they'll revert to the mean. And so he said, Wall Street will sell anything that will make them a fee. And so people listen to Wall Street instead of thinking independently and saying, well, is this going to continue? And so it's not enough to avoid standard stupidities. We also have to do some smart stuff, but it gives us such an enormous advantage just to start by saying, let me figure out what not to do. and that will help me. And this turns out to be an incredibly powerful approach, not only to markets, but to life. So if you think about the things that, when you read in the newspaper about somebody who's destroyed themselves or destroyed their family, you think about the things where, say, they've cheated their partner, or they've lied about their tax returns, or they've done some immoral deal because it was going to make them money in the short term, but it was not going to pay off in the long term, or they've been unfaithful to their partner, or they've mistreated their kids or something. These are pretty predictable patterns of things that people do that mess them up in life. And so I think this is a very useful approach. A friend of mine who's a successful money manager the other day said to me that after he read the chapter on Charlie Munger, he sat down and he spent 2 hours making a list of things that he would change that he's not going to do. And I would encourage people to do that, to say, okay, instead of just having a to-do list, let me have a not to-do list. I think that's a powerful, practical solution for many of us, just to reduce standard stupidity.
Definitely, that to-do list is something to look upon. You mentioned something very interesting in your book, in the chapter about Monish Pabrai, who's a great investor and a good friend of Guy Spear. Mentioned the idea of shamelessly cloning. So can you please expand on or explain that to our listeners?
Yeah, this is a beautiful idea. It's one of these very practical and simple ideas, similar to this idea of just avoiding stupid things, that has enormous practical benefits. And maybe I should take you back to the beginning of the Monish Pabrai story, which is in 1994, when he was killing time in Heathrow Airport. And he opens a book by Peter Lynch, and he reads about Warren Buffett for the first time. And he sees that Warren Buffett at that point had averaged 31% a year returns over 45 years, which I think meant that he had doubled his money 18 times. And so Monish, who was a technology consultant at the time and had managed to save $1 million, despite coming from a very, very poor background in the suburbs of Mumbai. And later, I believe he lived in Dubai with his parents. Monish said, well, this is really interesting. Here's this guy who has clearly won the game of compounding. And because Monish is very mathematical, he thought, well, if he's doubling his money at this rate, and he's already doubled it 18 times, he's going to become the richest man in the world. So he said, let me figure out how to reverse engineer what Buffett has done so that I can clone him, so that I can replicate what he's done. And so cloning is just a word for mimicry or replication or reverse engineering. But as I say in the book, it doesn't matter what terminology you use, because this is a technique that's for people who want to win, and they don't really care about looking smart and looking and being derivative from someone else. And Monish said that it's a superpower if you can do this, because most people, he said, there's something in our DNA that prevents us from cloning because we're so desperate to be original that we miss this low-hanging fruit that comes from saying, well, there's somebody smarter and wiser than me who's already figured out the answer. And so instead of reinventing the wheel, let me actually figure out why they win, and then let me clone that with relentless attention to detail in his case. And so what he figured out is, he said, okay, there are basically a handful of rules that Buffett, and later, as he realized, Munger lived by. And he said, it's as if they've actually revealed the financial laws of the universe. And he said, these laws are pretty much like the laws of physics. And he said, it doesn't matter whether you believe in gravity or not, gravity is going to pull you down. And so he said, when he looked at most other money managers, it was really like having a whole generation of physicists who were saying, no, gravity doesn't exist. And so he said, well, I'm not going to be a fool like that. I'm going to clone Warren and Charlie because these guys have figured it all out. And so one of the things that, in terms of the key laws of investing that he says were revealed by Buffett and Munger, he said, it all comes really from Ben Graham, Buffett's famous teacher. And the most fundamental ideas are, for example, when you're buying a company, you're not buying a piece of paper to trade, right? That was my sort of idiotic mindset as a 15-year-old when I was gambling on horses, where it was just speculating, it was just rolling the dice. He's saying, no, 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 what you're doing is you're buying a portion of an ongoing business. And because the market is bipolar and the market goes up and down and is kind of crazy at times, especially at extremes, the value of that business is often not reflected by the price of the stock in the market. And so the whole game becomes waiting for what Charlie Munger calls a mispriced gamble, where once in a while this crazy bipolar market will provide you with a mispriced stock. And then you leap with what Charlie Munger calls gumption and, you know, bravery, courage, and you grab this opportunity. And Munger has this beautiful image that I love, that I quote in the book, where he says that an investor should be like a spear fisherman, and you should be waiting by the side of a stream. Most of the time you're doing nothing. And then once in a while, a fat, juicy, succulent salmon swims by and you spear it. And then you go back to doing nothing. And he said, maybe you wait 6 months and nothing comes along. And so this is very different than what most money managers do. Think about, again, when we were listing some of the stupid things that you want to avoid. What Monish said to me is, most fund managers, maybe they own 100 positions, 200 positions, they're tiny positions, and they're trading them the whole time. They're renting these stocks. And he said, this really smart approach that people like Buffett and Munger take is to wait for that fat, juicy salmon, that mispriced stock that's so attractive that you just load up on it. And I thought there was a wonderful example of this with Monish's offshore hedge fund, where at some point, I think this is in 2018, he literally didn't own a single US stock in his fund. And so if you think about that, there's something like 3,700 stocks in the US market, if I remember rightly. And he couldn't find a single one that was cheap enough. And then around March 2020, when COVID was starting to take hold in the US, and there was a real panic and we were all forced to stay at home and nobody was shopping, all of the malls shut. And so the last thing you wanted to buy was an investment in a mall business, right? Because nobody is shopping. We didn't know how long COVID was going to go on. We didn't know whether there would be vaccines. And so there was just mass fear and panic. And so what Monish does is he finds this company, Seritage Growth Properties, which I have to disclose I own as well because I cloned Monish. And he said, this is a company where the debt is owned by Berkshire Hathaway, and Berkshire Hathaway is not going to destroy it. The stock is owned personally by Warren Buffett, and they own these amazing prime properties around the US in malls that are closed at the moment that everyone hates, but they're going to redevelop them, and they're going to convert these properties into mixed-use properties and all other things. Some of the properties are overlooking the ocean or near the water in beautiful places. And he said, I think this company is going to survive, and all of these people are just scared. All of the investors are scared of what's going on at the moment because people are just panicked. There's reason to panic. But he said, over 10 years, I think I'll make 10 times my money. And so you know, he lifts up his spear and he spears this fat, juicy salmon, and then he goes back to doing nothing. And that to me is a really fascinating example. And I don't know whether Seritage will work out as well as he expects. I hope it does, because I'm cloning him. But I think it's a beautiful example of how the best investors think, that they're not trying to make decisions the whole time. They're trying to make the decisions that they do make really count, really pay off. And there's a lovely line from Warren Buffett where he says, we're not paid for activity, we're paid for being right. And so this is one of those games where, unlike most areas of life where we're rewarded for being very active and very dynamic, here, a lot of the game is just to sit back patiently and not be ruled by the market, not be impatient, and just sit and read and think, learn, continuously learn, as Buffett and Munger do, where they're just reading the whole time. And then once in a while, something great comes along and you grab it with gumption.
Well, on the point of Seritage growth, I think you can still buy it at a price lower than Buffett's entry price.
That's true.
extremely hated stock at the moment, especially that the real estate is from, if I'm not mistaken, Sears. So it's very hated.
And I think Monish has already doubled his money in it. So it's a good example of something where when it's cheap enough, this is something that Howard Marks talks about. It's the perversity of risk, that sometimes you can buy something that's so hated that actually is so cheap that it becomes relatively unrisky. But you know, when I talked to Guy Spear owns Seritage as well, and I was saying to him, how come you're not buying more of it when it was being really killed? And he was like, yeah, but I'm more risk averse than Monish. And he said, what if it does go bankrupt, you know, back then? And so I think he added a bit to it, but not as aggressively as Monish. And so I think this is an important caveat about cloning, is that you have to clone in a way that suits your, excuse me, you have to clone in a way that suits your temperament and personality. And for Guy, he's much more conservative than Monish. And so Monish actually bought 13% of the whole company of Seritage. It was an incredibly brave move. Guy is much more conservative. And so this is one reason why I invest in Guy's fund, the Aquamarine Fund, is because I'm relatively conservative and I'm relatively cautious. And Monish is much more fearless and much bolder. And so I think you really want to take advantage of this benefit of cloning, of looking at what people who are wiser and smarter than us and more experienced than us have figured out. But then you need to do it in a way that suits your temperament and your skills. And so for me, I'm not going to ever be as bold and fearless as Monish. And so I'm happy to clone what he's figured out, but I'm not gonna do it with his aggressiveness.
So I'm just outlining some commonalities between the investors you've got. So the vast majority of them have a concentrated portfolio, and vast majority oppose leverage or margin, and most of them, if not all, are adopting a Stoic-like philosophy. So could you outline some more commonalities between the investors, and what can you say that other investors can easily adopt, which can be beneficial?
I think, to me, one of the most striking things that most of the greatest investors have in common is how unemotional they are. And I asked Charlie Munger if during the financial crisis in 2008 and early 2009, if he felt fearful or anxious at all, because he said that at the bottom tick of the market around March 2009, he bought an enormous stake in Wells Fargo, which everybody hated. I mean, it looked like the financial system was melting down. And he said this created a once in 40-year opportunity to buy one of the great financial firms. And so I think one of the questions is, how do you maintain emotional equanimity so that in times of volatility or in times of extreme ebullience, you're not going to lose your way and let your emotions get the better of you? And one of the things that Sir John Templeton said to me when I asked him for advice 20 years ago for the regular investor and for professional investors, he said, you really need to beware of your emotions. He said, most people act way too emotionally. They get really carried away and they jump into fads at the worst possible moment. And then they fail to take advantage of other people's emotions. And so he coined this wonderful phrase. He said that he tried to buy at the point of maximum pessimism. So when the market was getting killed, that was when Templeton liked to buy, because he said, when other people are desperately selling and urgently selling, that creates incredible bargains. And so I think one of the things that all of us need to think about as investors is, how am I wired emotionally to deal with both periods of extreme exuberance when everyone tends to get complacent or carried away and too reckless, and periods of extreme despondency when we tend to get too fearful. And most of us don't have the temperamental advantage that somebody like Charlie Munger has. And Charlie said to me when I asked him about this, he said, yeah, Warren Buffett's wired exactly the same way. He doesn't feel these emotions either. And so I think that self-knowledge is really important for me to know that I filter things through a lens of fearfulness in my case, or anxiety. That particularly strangely, one of the quirks that I have is that when everything is going well, I become fearful. So during times like this, where the market has soared, I have this kind of probably inherited sense that things fall apart and that I have to go very carefully. And so I just have to be aware of my own emotional makeup and try to compensate for the way that my emotions may be messing with my judgment. So I think for your listeners, one of the most important lessons is really to think about how they're wired, whether they're unemotional or whether they tend to be over exuberant, and to try to compensate for that in different ways. And so one of the things that I do, a simple rule that I have a sheet on which I write out my main investments. And I literally, there's a thing there that it says, my rule is that I'm not going to sell for 5 years. And so I literally have the date written on it where I'm allowed to sell any of these investments. And so I'm trying to force myself to be extremely patient, because I know that I have this tendency to get impatient, that suddenly I'll just want to do something. And that almost always in my career, in my investment career, not as a professional, just as a sort of serious amateur, I've done things too quickly, too hastily. And so I'm just trying to neutralize that flaw in my temperament, in my emotional makeup. And so I think to have that self-awareness, and then to have a few simple rules. One of the great investors I write about, a guy called Fred Martin, said to me that he's very focused on avoiding catastrophe. And so he said his adherence to process is very, very important. So he says he has a rule that he'll only put 3% of his portfolio in any company at the purchase price, and he'll let it grow. So it might become 10%, for example, because he doesn't sell. He tends to have a 10-year holding period for most stocks. But I think that's really interesting that he's systematically got this rule that ensures that he remains diversified enough. And so he would disagree with Monish. Monish would be happy to have 10 stocks. Fred Martin wants to have maybe 40, 45, 50. And he's been able to beat the market by a huge margin over probably 4 decades, while also being relatively conservative. And it plays to his strengths, I think, and to his temperament. And so I think there isn't a set rule where you should say, this is how many stocks I should own. This is, it depends on your temperament, on your ability to handle volatility and stress. And I think you want to figure these things out in calm moments, and not you don't want to be figuring out your philosophy for how diversified to be in the middle of a meltdown of the market, or right afterwards when you've been burned and you're likely to get the wrong lesson. So I think for all of us to have some kind of operating manual where you write down, what do I really believe about my approach to investing? What are my main principles? And why do I believe that over time this approach is going to work? And so then in moments of mayhem, for example, or moments where you're tempted to act when you're being impetuous and you'd be better off just waiting, you look at this sheet of paper and you say, oh no, I have a rule that I'm not going to sell for 5 years. Oh well, can't do that. And Zach, Nick Sleep's partner, said to me, they own Nick Sleep owns only 4 stocks, and Zach owns maybe half a dozen. And he said every 6 months or so, he'll open up his portfolio and he'll say, yeah, should I do anything? And then he says, then I ask myself, what would Nick do? And he says, Nick wouldn't do anything. And I close it up again and I move on and I don't look at it again for another 6 months. And so they've picked these stocks like Amazon, Costco, and Berkshire Hathaway that they've owned for many years. They've owned Costco for maybe 18 years and Amazon for 16 years. And they think that the destination is good. And so they're like, why should I do anything? And so I think knowing yourself and then giving yourself a policy statement that fits with your principles and your temperament, and then just sticking with it. that's something that I think can benefit all of us, because the psychological aspect of investing is really as hard as the intellectual aspect. I mean, I think most smart people, if they studied for a few weeks, could figure out how to analyze a balance sheet. But mastering your emotions, that's really hard. And we really need to think about that aspect very, very seriously.
You mentioned a couple of great takeaways, and also you've met with a lot of different people along these years. We've seen that along the way in the book. So I wanted to ask, what's a common trait or a one single advice that you can offer to our listeners?
I think to follow on from that point that we just discussed about emotions, I think you want to set your life up in a way that allows you to maintain equanimity and peace of mind. And so you have to think really seriously about your habits. And I write a chapter called High Performance Habits that talks about how when you pick good habits, the benefits actually compound over time. And so these small marginal advantages that seem really minor turn out in the end over 10, 20, 30, 40 years to be overwhelming advantages. So I would say, if you know that it's really important to have equanimity so that you can be calm, as Guy Spear once said to me, he said one of the reasons why he moved to Zurich, to this kind of boring but beautiful neighborhood of a very quiet, peaceful, stable town, was because he wanted his mind to be a calm pond. And that, to me, he had this lovely image where he said, because if my mind is a calm pond, I can see the ripples. And so then he can see when he's becoming panicked or fearful or too ebullient or too scattered. And so I think that's a really important model for all of us to think about. How do I create a mind that's a calm pond? And when you think of the habits of some of the great investors, they're pretty mundane, right? They meditate, right? You look at someone like Ray Dalio, who's been doing transcendental meditation for decades. Nick Sleep exercises a lot. He bikes a lot. He goes to this velodrome where he bikes. Monish Pabrai and Guy Spear exercise a lot. They're always biking, and Monish plays racquetball. And we know that these things like meditation and exercise actually have a really outsized role in giving us peace of mind. Likewise, I write a lot about Ken Schubenstein, another friend of Guy Spear's, who's a remarkable investor who's actually now become a neurologist. And so he's a real brain expert. And he says that there are four things that we know influence the performance of your brain. We know for sure from the science. And so we know that exercise, meditation, good nutrition, and good sleep all have a real impact on how well you think. And so when you're in a state, for example, he says, when you're hungry or you're angry or you're lonely or you're tired or you're in pain or you're sad or you're scared, those are all preconditions for you to make terrible decisions. And so I think one of the things that I would focus on that I think is hugely practical, and I've tried to internalize in my own life, is to try to create a lifestyle in which you're subtly tilting the odds of thinking calmly and clearly. And the fact that we know that things like meditation and sleep and good nutrition and exercise are so important. It's really simple, but most of us don't do it. And one of the things that Charlie Munger says is, take a simple idea and take it seriously. And I think this is a profoundly unappreciated idea, that when you find something that works, you want to be fanatical about it. I mean, you want to make it a real part of your life. And so to me, if I'm going to have a happy and successful life, that's going to have to come partly from thinking clearly and having internal equanimity. I mean, I could make a fortune and still be utterly miserable if I have no peace of mind. So I need to really think about these habits that will give me peace of mind and equanimity. And so that's something I would really encourage your your listeners to think about seriously? What are the habits that they've adopted that are going to lead over time to clear thought and equanimity?
Mr. Green, thank you very much for your time. We've listened to a lot of great advice, honestly, and I personally enjoyed every piece of it. So I appreciate your generosity in sharing all of this info. I'm sure our readers would enjoy this as well. Thank you for your time, and we look forward to share your book or even the upcoming books. Thank you very much.
Thank you so much for having me. And please, for your listeners, please feel free to connect with me on LinkedIn or on Twitter. I think I'm William Green 72. Email me. I'm happy to have an ongoing discussion with your listeners. And I hope one of these days that I'll be able to return to Saudi Arabia and see you all in person.
We would love that. You would be welcome anytime.
That would be wonderful. Thank you.